All right, we're still in inventory. We're looking at purchases. We just finished looking at the gross method and we're ready to look at the net method. A purchase is recorded at the invoice price less the discount when you're using the net method. If the invoice is paid within the discount period, the payment will be the amount recorded in accounts payable. So with perpetual, same situation where we had the $1,000 being purchased with a 2% discount. We're going to go ahead. It will be recorded at the $980, and we will debit accounts payable and credit cash for that amount. The periodic, it will be the same. Now, if the invoice is paid after the discount period, the payment will be more than the amount recorded in accounts payable because we'll have to pay the full amount. We're not entitled to take the discount, whether it's 2%, 1%, whatever the amount is. All right, under perpetual, we will debit accounts payable for $980 because that's what's showing in the account. We recorded it as the net amount, assuming at the time that we were going to pay within the discount period. We will have to debit purchases discounts lost, which is an expense account for the $20, and we'll credit cash for the full $1,000. The periodic method, it is the same. Now, here's an example. We have Burton Company purchases $4,000 of inventory with invoice terms of $210 net 30. We're to prepare the journal entries for the purchase and payment. First of all, we'll go through and pay it. We'll show it as if Burton pays within the discount period. Perpetual, well, 4,000 times 2% is $80, and so 4,000 less $80 is $3,920. So we debit inventory, we credit accounts payable for that amount. We pay it within the time frame by the discount due date, within 10 days of the invoice date. We debit accounts payable, we credit cash. Periodic method, we debit the purchase to purchases, $39.20, and we credit accounts payable because we're recording it as the net amount. To record the payment is debited to accounts payable and credited to cash. The second alternative is if Burton pays after the discount period. Well, once again, to record the purchase, we're debiting inventory, crediting accounts payable for the net amount of $3,920. To record the payment after the discount period means that we're going to record purchases discounts lost of $80. That's an expense. Accounts payable will be debited for the $39.20, which is the amount that we set up, the net amount, and we're crediting cash for the full amount due. Periodic, remember we debit purchases for $39.20, the net amount, credit accounts payable, and to record the payment is the same as we did under perpetual. We still have to recognize purchases discounts lost of $80 and a full cash payment of $4,000. Perpetual method journal entries. Under the perpetual method, the inventory and cost of goods sold accounts are always up to date. The question is the inventory account balance correct just because it's supposed to be up to date? To verify the balance, the company still needs to conduct a physical count of inventory. If there is shrinkage, a loss of inventory, an adjustment is made to the inventory account. The journal entry to do that would be to debit inventory shrinkage expense account for the amount of the loss, the dollar amount of the loss, and to credit inventory. Periodic method adjusting journal entries. Well, the inventory and cost of goods sold are brought up to date at the end of the year or some other period. If you're preparing interim financial statements and you want to update them quarterly or semi-annually or even monthly, then you can do that too. Until then, inventory is still going to be showing a beginning balance. It does not include purchases, which have been recorded in temporary accounts such as purchases sprayed in, purchases discounts, purchases returns. Those are all temporary. So one journal entry closes out the temporary accounts, adjusts the balance in inventory, and recognizes the expense, cost of goods sold. We have our beginning inventory plus our net purchases less our ending inventory equals our cost of goods sold. So the beginning inventory is on the books with a debit balance when we start the period. The net purchases, well, those are the purchases on the books that have a debit balance. It also includes freight in with a debit balance. It will then be you'll need to subtract purchases returns and purchases discounts because they're on the books with credit balances. They're contra purchases accounts. The ending inventory then needs to be recorded on the books with a debit balance, and that's done so based on a physical count that is taken, so that we come up with a count of the inventory and a dollar valuation of the inventory. Then cost of goods sold needs to be recorded on the books with a debit balance. Alright, looking at this, we are debiting ending inventory, crediting beginning inventory, crediting purchases freight in, debiting purchases returns, and purchases discounts, so that the temporary accounts are closed out at the end of the period, and the information, the dollar amounts, are transferred, and we then have our cost of goods sold dollar amount that will show on the income statement, and a new ending inventory amount that will show on the balance sheet. Here we have an example. Brighton had beginning inventory of $24,000. A physical count of the ending inventory reveals $18,000 of goods. The records from the year indicate that Brighton purchased $60,000 of goods and paid freight of $2,000. There were $3,000 in purchase returns and $1,000 in purchase discounts. We're to calculate the cost of goods sold and show the journal entry to close out inventory. Alright, it's good to keep in mind that over on the left, the beginning inventory plus net purchases less ending inventory equals cost of goods sold. And we can start to work with our numbers. The 24,000 is beginning inventory, 18,000 ending. We had 60,000 purchased, 2,000 in freight, less 3,000 in purchase returns and 1,000 in purchase discounts. So the net purchase amount is 58,000. When you take the 24,000 plus the 58,000 for net purchases, subtract 18,000 in ending inventory, the cost of goods sold is 64,000. We now have all the numbers we need to prepare that journal entry. So we're getting started. We're debiting ending inventory 18,000, crediting the beginning inventory 24, crediting purchases for 60, freight in for 2, debiting purchase returns and purchase discounts for the 3,000 and 1,000 respectively, and that leaves us cost of goods sold that will be debited for the 64,000 that matches the computation previously. The debits equal the credits, and we have closed out or transferred the amounts from the temporary accounts to cost of goods sold, and we've updated the ending inventory. Well, the units sold, what did they cost? A firm may actually buy hundreds of units from dozens of vendors and sell them to thousands of customers. Tracking the original cost of each unit sold would be impossible. To make tracking inventory practical, GAAP, Generally Accepted Accounting Principles, permits the company to use one of 3 methods to calculate the cost of units sold. We can use average costing, we can use FIFO, first in, first out, or LIFO, last in, first out. So let's go back through these different methods. Let's start with average costing. Average costing can be used under the periodic or the perpetual methods. Periodic method, because cost of goods sold is recorded only once a year, a weighted average is used to compute the units sold. Under perpetual, because cost of goods sold is recorded at each sale, We have a moving average that is used to compute the cost of each unit sold. So after each purchase, the cost of the unit sold moves. We have an updating of the cost. It changes when we have new purchases. Under the periodic method, the average cost of each unit sold is computed at the end of the year or other period to determine the cost of goods sold. The formula to compute weighted average costing is as follows. The goods available for sale in dollars divided by the goods available for sale in units. Remember that the goods available for sale equals your beginning inventory plus your net purchases, and net purchases would be your purchases plus freight in, less returns, less discounts. Alright, here's an example. We have beginning inventory 140 units at $7.90 per unit for a total of $1,106. There's a February 3rd purchase of 217 units at $8 a unit for $1,736. There's a March 15th sale, 300 at $12. That $12 is the sales price. Okay, keep that in mind. April 12th, there's a purchase of 100 units at $8.22 for $822. July 18th purchase, 210 units at $8.40 for $1,764. September 1 sale, 250 at $12. Again, that is sales price, not cost. And then the last purchase is on November 24th, 240 units at $8.75 for a total of $2,100. Then there's a last sale on December 12th, a sale of 128 units at $13. That is sale price. Now, the company uses the periodic method. A physical count on December 31st shows that there are 229 units on hand at year end. You should also be able to take the beginning inventory, add all the purchase units, subtract all the sold units, and that should reconcile to 229 units on hand at year end. What we want to know, we want to be able to answer, what is the average cost per unit, what is the ending inventory, and what is the cost of goods sold. Well, we need to figure out what the goods available for sale are. So by adding beginning inventory plus each purchase, there are 907 units available for sale. Add the total amounts for the beginning and for each of the purchases, and that's 7,528. We can ignore the unit costs for the time being. So what you need to do is divide $7,528 by 907 units. That yields $8.30 average cost per unit. And if you scan through all your cost figures, the lowest cost was at the beginning, $7.90, and the highest is $8.75. You would expect the average to be somewhere between the high and low. And this is a weighted average, so the more that's purchased at one particular unit cost will cause the average cost to be closer to that. Alright, now, we know there are 229 units in ending inventory. We can multiply that times $8.30, and that gives us $1,900.70. There were 907 units available. That means 678 units were sold. That is our cost of goods sold. You could take and add up all the sales of 300, 250, 128. That's 678 there. You multiply it times the $8.30, and that's $5,627.40 for cost of goods sold. The ending inventory appears on the balance sheet. The cost of goods sold appears on the income statement, and the total goods available for sale, well, that may be on the income statement as well. It would be under periodic that would be showing in the cost of goods section.